One property isn't going to change your life, but 5 might. Most property investors buy one property and then stop because it feels like a lot of money being spent on an asset that's only producing you a couple of £100 a month in return. These people often look back after a couple of years and wonder why they're not seeing real wealth growth. But what if you could scale to 5 properties, even with just the one deposit you started with? If you're new here, welcome. My name's James, and this channel is all about helping you build and grow your knowledge about property investing without gimmicks or unrealistic promises. I'm the co-founder and managing director of a property investment business called Frater Property Partners, but this channel is all about helping you grow your knowledge. If you like the content, don't forget to hit like and subscribe to the channel for all things property investment. If you're not new here, you might see the background is a little bit different today. I'm actually working remotely in Sicily this week, spending time with family, but I told myself I wouldn't skip a week on the YouTube videos, so here we go. If we're looking to grow our wealth over time within property, we need to start with one solid deal. This deal needs to have all of the fundamentals that we've talked about in previous videos and give you the best opportunity to grow your wealth through the appreciation of the asset. If you can buy a property that you're confident will grow in value in the long term because it has all of those fundamentals, then you're onto a winner to start off with. And even better, if you can marry this with buying at a discount or buying below market value, you're going to maximise your opportunity to build your wealth through property as you already have immediate equity at the point of purchase. Having said that, you can still do this by buying at market value and not focusing just on buying below market value or at a discount. I often see people who have convinced themselves they have to buy at a discount or below market value and end up ignoring the true fundamentals of an investment because they're too focused on buying at a discount. Just because you're able to buy at a discount or below market value doesn't necessarily mean you're going to be buying a property that has all the fundamentals and will give you the opportunity to build your wealth. But if you can do that and you found a property that ticks all of the boxes in terms of fundamentals and gives you immediate equity at the point of purchase, then you're onto a winner. Not only this, the first property that you're going to purchase has to cash flow positively. So it needs to pay for the mortgage that the property is going to have on it, plus earn you a small profit each month in and around £300 to £350 in the current market. This is because you'll need to be paying for things like maintenance costs and give you a little bit of wiggle room if rates change in the future, but really you build your wealth through the equity growth, not the cash flow. So you've bought your first property and it has all of the fundamentals. How can you then scale to multiple properties to achieve your long-term goals and eventually hit the big target you're aiming for? The truth is, time is your best friend within property investment. Give yourself time for that property to grow in value. After a couple of years, once it's grown in value because of the fundamentals and demand, you have the opportunity to refinance that property at a new value, release equity and use that equity as a deposit or a down payment on your next property investment. For example, if you buy a property worth 200k, you'll need around a 50k deposit. Let's say for this example, you've bought at market value. After a number of years of reasonable growth, that property should have grown in value to give you the opportunity to refinance it. Let's say for argument's sake, this property that was worth £200,000 is now worth in the region of 270k. You refinance it at the new value, release 50k and use that 50k as the next deposit on your next investment property. Obviously here you will have to pay for a few things like stamp duty, legal costs and broker fees. However, you could wait for another year to do that, but if you have the cash to do it, I would usually top that up and then scale from the 2 properties and so on. The chances are, if you're looking to invest in property, you probably have the ability to save some cash. Once you know what your plan is, you know how long you have to save that cash, you can put some money aside each month or each year to then put into your stamp duty and everything from that perspective. In these early days, we are going to use leverage as much as we possibly can to scale the portfolio, and then we'll reduce debt further down the line. If you don't understand leverage or you don't understand why you might do that, then I have done a video on that previously and I'll put that link in the description. So let's look at an example. Historically, property prices usually double every 10 years or so. If we look at the data, we can see that's around 7 to 7.5% growth per year in the long term. Obviously in places like London, as we've touched upon in other videos, that's very unlikely to happen because of affordability. But if we buy in the right locations and we target the right locations, because of the fundamentals, we should still see some strong growth and good appreciation in the long term. So let's look at the numbers and we can see what that actually looks like and how it plays out over a 20-year period. So The first thing we need to do is look at a target. For this example, let's just look at £5,000 a month from your property portfolio. So what that means is in 15, 20 years time, however long it takes us to get to that goal, we need to know that we'll have an equity within our portfolio of around £1 million. That's assuming that if you own a portfolio outright worth £1 million, you're getting a 6% net yield on it, and that will give you £5,000 a month. Once we've done that, we then need to look at what happens if we buy the right properties in the right locations moving forward. Savills have projected the Northwest to grow by around 29.4% over the next 5 years, so from the year 2025 to 2029. So that's just under 6% growth a year. So I'll put 6% in for the time being, just to show what that looks like. Again, it's not me saying that that will definitely happen, but it shows you what can happen to your portfolio in and around these figures, and gives you the opportunity to look at the compounding effect and scaling that portfolio. So again, looking at this example, we're purchasing a property worth £200,000 and it's going to grow by around 6% every single year. We can see the growth and see how that works over an extended period of time. So we purchased a property worth £200,000. That has a mortgage worth £150,000 in and a £50,000 deposit. That property, after 1 year, will have grown to around £212,000, which means our total equity has gone from £50,000 to £62,000, and we've got £9,000 of investable equity that we could release in terms of a refinance if we really wanted to. Obviously, we're not going to do that. £9,000 doesn't get you very far in property, and also the likelihood is you'll have a 2 or a 5 year fixed mortgage on your property. Having said that, after 5 years, that property will have grown from the £200,000 mark to around £267,000, £268,000. That is £117,000 of total equity. So that £50,000 has grown to £117,000, which gives us just over £50,000 of investable equity we could release through a refinance to then use as a down payment. As you can see, we will then purchase a property with that down payment, top up the difference. So we've gone from 1 property to 2 properties by recycling the same deposit after 5 years worth of growth. We essentially just rinse and repeat this cycle for the next 10 years, 15, 20 years, depending on what your goal is and what that looks like. You can see here in year 10, you've got enough investable equity to purchase 2 properties. That essentially is just saying that you've got £50,000 twice to purchase 2 properties if you really wanted to. In 10 years time, your money can probably buy you a lot less than what it can buy you today. So the likelihood is you're not going to buy 2, you might just buy 1 property, but it's the value of the property. You've got £100,000 that you could put in as a deposit, pay for fees and scale the portfolio further. Again, this is just a rinse and repeat of the same thing we saw within the first 5 years within the next. If we don't do anything from then on, we've got a couple of properties that are growing in value over the long term. We can then see after around 20 years, without buying any more properties, without refinancing any more properties after year 11, we will have £1 million worth of equity within our portfolio by year 20. That's on the basis that you put £50,000 in as a deposit in year 1, you recycled that deposit in year 5, you did the same again in year 10, 11, and then you did nothing to the property portfolio other than allow growth to do its thing to get you to that goal within a 20-year period. If you decided that you wanted to get there sooner and you still wanted to refinance your property portfolio in year 15, then the chances are you're likely to get there in 17, 18 years. But again, what's the difference between 2 or 3 years? And what you can do is you can see that your mortgage balance stays the same, whereas the portfolio just increases, which improves your loan to value. Again, this is just an example of what can happen with the compounding effect and recycling your deposits every few years by buying in the right locations and allowing property to grow in value and being patient. As a property investor, the chances are you might have a bigger goal than £5,000 a month, and the chances are you're going to have more than just the £70,000 when you're starting out. At my business, Frater Property Partners, we go through a slightly more in-depth version of this and look at what might happen in the long term. Again, there's no guarantee that property prices will continue to increase at that level, but it can show us what could happen in the long term if we do the right thing and we're patient. You can also see if we purchase property again, let's say if we're able to purchase property every 2 years for the first 5 years and then do nothing else, we can hit that £1 million worth of equity in year 12. So it's obviously a lot faster. And if we wanted to get to 2 million to earn 10k a month, we do that in year 17 in this example. So this is really where property comes into its own. It's the opportunity to leverage, to be patient, allow properties to grow in value, refinance and recycle your equity, and then get to your long-term goals to build that financial stability and that security in the long term. Now you've seen an example, hopefully you now understand the beauty of leverage and the ability to scale your portfolio over time. Again, this isn't something that happens overnight. It will depend on your capacity. It will depend on you buying the right properties in the right locations. But if you do that and you're patient, you will build your wealth to give yourself that financial independence and that freedom. So this model is very much focused on working with a hands-off property investor, but hands-off doesn't mean no work at all. It just means partnering with the right people, being patient and giving yourself the opportunity to build your wealth through property without doing things like projects like flips, refurbs or HMOs or anything like that. One of the reasons I always talk about goals and working towards them in the long term, whether that's £5,000 a month, £10,000 a month or anything in between, is so we can make informed decisions now to be able to give ourselves that freedom in the long term. One of the big mistakes I see a lot of people doing when they're starting out or when they're scaling the portfolio is buying cheap properties in the wrong locations. Lots of beginner property investors purchase properties in seaside towns in the northeast because they're cheap. The reason they're cheap and they have a good yield is because they've had a lack of growth in the last few years because demand isn't there for the local market. That doesn't mean there's not going to be any growth, but it does mean that there's not necessarily going to be enough growth to give us that opportunity to scale the portfolio through refinancing in this way. So if you want to do buy, refurb, refinance or project-based property investment, then yeah, the Northeast could be a good location to do that, but it's probably not going to be the place, in this example anyway, that we're going to be investing in property that will refinance and scale the portfolio in a more hands-off way. Don't just buy your first property without planning on where you want to be long term. You need to know your strategy and you need to know what your end goal is. This is because investors often buy one property, get worried that they're not getting the returns they expected, change their strategy, do it again and again and again, and then never achieve their long-term goals. So whether you're investing from a hands-off perspective or you're doing project-based investments, buying in the right location is super important, and being patient is also one of the things that will really give you the chance to build that wealth. So to conclude, you don't need 20 properties. You might just need the right 5. If your goal is punchier or you have access to more cash, then obviously that goal might be slightly different, but the concept works the same. Remember the 3 Ps: planning, patience, and partnering with the right people, especially if you're not based locally to where you're investing. But that is it for this week's video. So thanks again, and I'll see you in the next one.